Hey guys, let's look at the 1958 letter that Warren Buffett wrote to his limited partners from his Buffett Partnership days. Here he starts off by talking about how there are undoubtedly more mercurially tempered people in the stock market now than for a good many years, and the duration of their stay will be limited to how long they think profits can be made quickly and effortlessly. While it is impossible to determine how long they will continue to add numbers to their ranks and thereby stimulate rising prices, I believe it is valid to say that the longer their visit, the greater the reaction from it. So Warren Buffett is saying how speculators are driving up the stock market and they're just in it for the quick buck. And when this euphoria, this party ends, it is going to be detrimental for the stock market. Next, he talks about how he makes no attempt to forecast the general market and that all his attention is devoted to finding undervalued securities. He does believe that the widespread public belief in inevitability of profits from investments in stock will lead to eventual trouble. So in this paragraph, he talks about how speculative thinking will lead to trouble and that stock prices will be affected, but the intrinsic value, what the asset is truly worth, will stay intact. In the next segment, he compares his partnership returns to the market performance and how his partnership, his portfolio beats the Dow Jones Industrial Average. Next, he talks about one of the largest holdings, which comprise of 10 to 20% of the assets. He referred to this in his 1957 letter. In this 1958 letter, he actually discloses and gives us the name of that company, which is the Commonwealth Trust Company of Union City. And he describes how it had an intrinsic value of $125, had earnings of about $10 per share, and was trading at $50 per share. He says that it was a well-managed bank, had the earnings power, and had a large discount from intrinsic value. He then describes the three characteristics that made it more enticing for him to buy the company. The three factors were strong defensive characteristics, good solid value building up to a satisfactory pace, and then evidence to the effect that eventually this value would be unlocked. Buffett then talks about his thought process, how he wished the prices were dormant since he could have added and increased his allocation, but that was not the case because the stock price soon rose up to $80 per share, and then he had to get out of the trade because he got the terms that he needed. And at that point, the margin of safety was not as high. And so in the previous letter, he described how he was going to buy more shares if the prices went down. But if the prices went up, he would start cashing out the profits. And that is what he did now. The prices did not go the way he wanted. And so he took the money out of the Commonwealth investment and put it in another investment. So in the end, he talks about the opportunity cost involved with investing his money within the company. He then talks about the current situation of the portfolio and how it's more difficult for him to find undervalued securities given how elevated the current stock market is. However, he does specify that he's still trying to acquire large positions in several undervalued securities. So the key takeaways from this 1958 letter were: first, speculators who are in it for the quick buck will drive the stock market higher, but will eventually get themselves in trouble when the market does correct. Second, during a market downturn, the stock prices may be impaired, but the intrinsic value will stay steady. Third, Buffett talks about how during a bull market, he wants his portfolio to match the average's performance, and during a bear market, he wants to beat the Dow Jones Industrial Average. Fourth, he talks about how we need to focus on the intrinsic value and compare the intrinsic value to the stock price. Look at the earnings power and the management. Fifth, invest in undervalued, well-protected securities. And lastly, look at the opportunity cost. And it is also totally fine to build a concentrated portfolio. That is all I have for the 1958 letter that Warren Buffett wrote to his limited partners. Please do like, share, and subscribe to my channel. Thank you.